sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, does making clothes for Olympians help your stock? And what are kids buying for back-to-school season? Telsey Advisory Group CEO Dana Telsey on the big winners and losers and insights on the health of the consumer. And later, big changes coming from Merck's top-selling medication and how weight loss drugs might help protect you against Alzheimer's. We'll look at how it's impacting investors in the biotech and healthcare sectors. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Elizabeth O'Brien, and Al Root. So, Ben, it was a horrible week for stock investors. The NASDAQ now officially in correction territory. What caused all the selling?
Well, Jack, it wasn't really a horrible week. Okay. It was really horrible 2 days. I mean, all this
seemed like a week.
Seemed like a week. I mean, it was the horrible Thursday and Friday, and it wasn't even just the NASDAQ. The Russell 2000, remember we were all talking about this rotation into small caps, got crushed as well. The S&P, the Dow also finished down a lot. And really, there's two problems here. One, the market has been resting on two pillars. One is the AI tech trade. Everybody wants to own these big stocks, and when they go up, they carry the market with it. But then everyone's been talking about rotating into smaller stocks, about the economy doing, getting the soft landing, and that was going to be helpful too. And then all of a sudden, you pull out both those pillars, and the market goes down.
To your point about it not being completely a bad week, Jim Grant had a wonderful statistic that NVIDIA had a terrific rally that added more market value than any stock ever has in the U.S. market. And yet, of course, it's having a pretty bad week.
Yes, it is.
So the Fed raised rates, obviously, to fight inflation with the only tool it has, which tamps down the jobs market. Did it go too far?
I mean, that's the worry right now. We got this jobs report that was really not good. I mean, it missed the number of jobs added, missed by a lot. The unemployment rate rose to 4.3%. And that really has people concerned, especially because we're also seeing weakness in other indicators. Like there's a manufacturing survey that came out on Thursday that actually started to sell off of its own. And so the concern now is that, the Fed hasn't gone soon enough, and it's left rates too high to the point where we now have more than a 60% chance that you're going to get a half-point cut at the meeting in September. And just a few weeks ago, we were debating whether there would even be a September cut at all.
So this week and that potential half-point cut reminds us why there's the 40 and the 60-40 portfolio. Bonds had a terrific week, rallying strongly. That's good for retirement accounts. Where do we go from here?
I mean, I think that what's the best thing about that is that we'd been at a point where bonds weren't helping when the stock market went down. They would both fall at the same time. And that was problematic if you're looking for something to help you when your stocks weren't doing well. Now bonds are doing okay. TLT, that's the long bond ETF, gained over 5% this week. So It really did provide some ballast. And you know what else did well? Dividend stocks. They were actually flat on the week, which is not bad considering how much the market was down.
Let's take a closer look at some of those tech names that had a rough week. Elizabeth, 4 of the Mag 7 reported. Investors continue to be concerned that all this spending in AI might not get the payoff they'd thought maybe a few months ago.
That's right, Jack. It is an AI arms race. Meta alone plans to spend about $40 billion on capital expenditures this year. That is more than 20% of its expected revenue. And Alphabet shares fell when Wall Street analysts were surprised at the magnitude of its AI spending. Now, artificial intelligence hasn't really lived up to the hype. It hasn't contributed too much to earnings so far, but the promise is too big to ignore. And even within Microsoft's sort of disappointing revenue picture, there were signs of that. Overall, cloud revenue was disappointing, but AI was a bright spot within that. And some say Apple is sort of the Goldilocks of AI spending. It's not spending too much, not too little, just enough. And its third quarter spending was about $2.2 billion.
And Meta also had a decent week in terms of the stock market. An incredible statistic, 3.27 billion active daily users, 40% of people on Earth. Real quick, Intel, not a good week, not a good decade. Tell us about that.
Very bad day for Intel on Friday. It's worst since at least 1985 as it slashed jobs and cut dividends. Now, Intel used to be the leader in chips, but no longer. It hasn't been for a while. There's some hope that a new manufacturing process will turn things around and make it competitive again, but don't expect to see results on that until the second half of 2025. One thing to remember, though, with Intel is that the government has a vested interest in it doing well and it having a domestic chip producer. So I don't think it's going to go away anytime soon.
Yeah, that's a good point. Al, we've talked about a lot of headwinds here. Few big companies have more headwinds than Boeing. A new CEO will take the reins on August 8th. What's on his to-do list?
Yeah, and I tried to memorize this and I couldn't do it, so allow me to look down. Production, they're not making enough planes right now. Quality, we had the 737 MAX blowout. There's regulatory issues related to the MAX, but also they're trying to get new products approved. They have capital problems. Their debt has exploded since the pandemic. Engineering, they're going to need to do a new plane someday. The supply chain has been a headache for everyone in commercial aerospace since the pandemic. And oh, by the way, there's M&A. They need to reintegrate a supplier they spun out almost 20 years ago.
Other than that, Mrs. Lincoln.
Other than that, things are great.
Okay, so one of the management rules is you can't do everything. So the rule of three, you take your 3 top priorities, you focus like a laser on those. You just named 18. Yep. What are the top 3?
So Kelly Ortberg, former CEO of Rockwell Collins, universally praised choice. But to answer your question directly, production, supply chain, and quality. That's about getting planes to customers. It's about keeping your customers happy. It probably will have some ancillary benefits for the culture to see things. And then I'll throw the other one in there. You got to start articulating a plan for balance sheet repair. Too much debt, balance sheet repair, and production quality.
$58 billion in debt. Yeah, we'll give him a little time. He's got a lot of problems to fix.
And that's the thing. I don't think you can expect to see improvement like that. This is a 2026 improvement story.
Alrighty, thanks, Al. After top retail analyst Dana Telsey recommended shares of Abercrombie & Fitch, that stock went on to crush the Mag 7, including NVIDIA, over the past year. What does Telsey like now? She'll tell us next. Spending and real wages continue to hold strong, but American shoppers are focusing more on finding their most bang for their buck, bargain hunting as prices remain high. How are retailers balancing the challenge, and where can investors find opportunities? Here to react is Telsey Advisory Group CEO Dana Telsey. Dana, great to see you again. Thanks for coming on.
Thank you for having me, Jack. Great to see you, too.
So I think I really want to start with the Olympics. Ralph Lauren outfitted the U.S. athletes. He won't let us forget it. Is this benefiting sales? Is it helping the stock?
It does. It builds the awareness. You've seen them have collaborations with other sporting events. Certainly with such a global platform as what you have at the Olympics, opening and closing ceremonies, it's a driver of awareness, driver of consumer attraction, and I think a driver of conversion in the apparel. So I think it is a benefit.
And
watch for the U.S. Open tennis matches, too. They'll be there also.
Okay, and you like that stock, correct?
I do. AUR is increasing. That's their average unit retail selling price. They've been very focused on enhancing the distribution in department stores, really uncovering some of the non-core categories that can grow, whether it's women's, whether it's outerwear, whether it's home. And they've been managing their inventory, and they have a solid balance sheet.
So another big Olympic player is LVMH. I think they're spending even more in promotion than Ralph Lauren. We saw them in the opening ceremonies. Do you like that stock? I think it's the largest luxury company in the world.
It is the largest luxury company in the world. It is not a good time for luxury right now because there is moderation, but that also creates opportunity. And like you said, Jack, given it is the largest player out there with 75 brands and the strength of Louis Vuitton and Christian Dior, I think there are opportunities for LVMH, and this is one of them. They're a company that's built for decades, not just for days.
Already, it's back to school season, and one big beneficiary is likely to be Abercrombie & Fitch. This was a call of yours, and it was a good one over the past year, up 240%. That's more than NVIDIA. Do you still like that stock, and what are they doing so well?
What Abercrombie is doing well is they really use the data they have on their customer and really transform the core Abercrombie brand. So now it caters to 25 to 40-year-olds, and it's selling outfits, not just items. And keep in mind, they did it on the operational side, too. They enhanced the store base by getting rid of some of those flagships that weren't as productive, have smaller boxes that are technically more efficient and driving profits. Watch this year for the Hollister division, where the apparel assortment is more in tune, and that's the next leg of growth, along with international.
My 10-year-old daughter loves her Hollister. My wife, meanwhile, likes Birkenstocks. That company, even older than Abercrombie, I think it's about 250 years old, but the stock only went public last year. You're a fan.
I am a fan, and I think what you see at Birkenstock, you see momentum, you see full price sales, you see the opportunity to expand distribution. And wouldn't you know, closed-toed shoes now are nearly 25% of sales. It's a higher average selling price and gives all those Birkenstock owners more reasons to buy another pair. And don't forget what they're doing in terms of the audience that they're seeking. Now, whether it's hospitality, whether it's healthcare, whether it's restaurants, they're expanding the purview of who their core customer can be. It is certainly a brand that, while it's 250 years old, watch the next decade, because there's a lot of young there where they're expanding their audience.
All righty. And you are a really good trend watcher. You know, you spot these things. One thing you've been talking about is cowboy boots and skirts. I thought that was just a Nashville thing, but no, they're on the streets of New York City. They're everywhere. Does that have legs? And what does that mean for retailers?
I think it does have legs. And like you, I see it on the streets of New York, too. Who would have ever thought in 90-degree weather women would be wearing with their shorts and skirts cowboy boots? But you know what it's also driven by? Looser fit, wider leg denim jeans. So I have multiple tops and bottom separates that's calling for new shoes. Boots were strong in July, and I think that's a good read for the momentum that could carry into the fall.
All righty, speaking of the fall, we got about 30 seconds left. You pointed out that an interesting little quirk of the calendar later this fall is going to cause a problem perhaps for holiday shopping.
5 fewer days between Thanksgiving and Christmas, so you better do your purchasing early. Back to school, I think, will be very measured given the volatility that we're seeing out there. Lower income consumers spending less, higher income consumers spending on experiences. You really need innovation and newness to drive demand. Holiday season, if we're seeing this measured approach in back to school, you got to be a little cautious also for holiday. Luckily, inventory levels need to remain clean, and they're doing that.
Dana Telsey, thank you for explaining this all to me. Really appreciate it.
Thank you. Have a good weekend.
You too. It's a high-stakes race to discover the next blockbuster drug as Merck's Keytruda patent expiration looms. What it means for Merck, investors, and the pharmaceutical industry, next. Merck's top-selling drug, Keytruda, has revolutionized cancer treatment and will rake in a staggering $25 billion this year. But its patent is set to expire, and Merck needs to figure out how to replace it. Elsewhere in the sector, recent research showing progress against the scourge of dementia. Merck is this week's Barron's cover story, so let's start there. Ben, why is Keytruda such a big deal?
Well, I mean, Keytruda is a drug that, you know, if you got skin cancer, you had a 25% chance of living past a year. With this drug, you know, the average lifespan went out to survival rate went out to 2.5 years, and 40% of people taking it lived 7 years or more. I mean, so it really changed outcomes for people who got cancer, and it became the top-selling drug in the world. And that's really all you need to know about this. The big issue for Merck now is that it does have the successful drug that now everybody is, come 2028, people will be able to launch biosimilars and start making their own versions of it.
The patent cliff, as it's called.
Yes.
So what strategy does Merck have to try to keep on making money after going over the cliff?
Well, I mean, I think the big thing you have to remember about drug stocks is that, you know, there's always, this is an issue that they all have. And so the big problem is when you don't have something to replace it. I look at Gilead, which had this hepatitis C drug that actually cured hepatitis C. It was amazing. Stock went straight up. Other people started launching their own versions of it almost immediately, and the stock fell because there was too much pricing pressure on it, too much competition. You see it with Pfizer and with Moderna, where these vaccines for COVID did so well for them, but then went away and there wasn't anything to replace that revenue. What's good about Merck is that only about 40% of its sales come from Keytruda. And it does have a pipeline. It has, I'm going to have to look down at my notes. It has a drug called Winrevair that is that's just being started to sell now. It's for heart disease. That's doing well. It has an HPV vaccine that's doing pretty well too. It has other things. They think that they can get about $35 billion from their pipeline. And Keytruda is not going away. They're coming up with perhaps a version where instead of taking it intravenously, you would actually be getting it with just a shot, and that could prolong the sales for the drug as well. So I think there's actually a lot to like about Merck here. It's not just a one drug pony.
Got it. All right. But even more exciting, perhaps, or at least more of a blockbuster than Keytruda are these GLP-1 drugs for weight loss, Elizabeth. And now we're discovering, wow, they could actually help with a lot of other diseases as well. What's the latest research showing us?
Yeah, absolutely, Jack. So both Novo Nordisk and Eli Lilly have these blockbuster drugs. And a recent study out of the UK suggested that an older GLP-1 drug from Novo could slow the progression of Alzheimer's disease. But it's not just weight loss. There is some more research out of the UK recently showed that Glaxo's shingles vaccine, I'm going to have to look down too, Shingrix, may delay the onset of dementia as well. Now, these are relatively small studies, relatively incremental results, but Alzheimer's is such a devastating disease, and people are paying attention and looking for some hope.
All right, well, that's good news. Al, meanwhile, the adjacent sector of biotech has had a really bad few years. What's going on there? You do see some signs of hope.
Yeah, and it's been terrible. If you look at the XBI or any of the biotech ETFs over the last 5 years, up about 15%, trailing the market by about 65 percentage points. So it's been really terrible sector. Coincidentally, I think it's actually more of a rate trade. Biotechs are typically speculative stocks, a lot of binary outcomes. The drug works, the drug doesn't work. There's a lot of smaller capitalization stocks. About 2/3 of the large biotech stocks in the U.S. lose money. About 2/3 have market caps below $5 billion. So it's a speculative sector. When rates go down, it's cheaper to speculate.
And also, you always recommend the index rather than trying to pick winners and losers, right?
Yeah, you can even Aaron Judge hits a home run 8% of his plate appearances, which is incredible. It is so hard, even if you're Aaron Judge, to hit the baseball. It is so hard, even if you're a doctor, to pick biotech. So that's why I like the ETF strategy.
Real quick, in the bigger drug industry, Barron's ran a screen, found a few big cap winners.
Yeah, Merck is unloved by investors right now. So we said, well, okay, if you want growth and you want some confidence, like Wall Street likes these things, what should you buy? Interestingly, Merck screened very well. 80% of the analysts recommend it. It's actually still growing its earnings. It only trades at 12 times. Then you have Regeneron, Vertex, and Eli Lilly. Those are growing, a little more expensive, 20 to 40 times. And the last pharmaceutical stock, which is a bit of a secret pharmaceutical stock, Zoetis. 90% of the 90% of the analysts like it. That's drugs for your pet.
And they like it because it's for animals. Thanks, Al.
That's right.
Al and Ben have a pair of investment ideas, and Elizabeth will tell you how to prep your portfolio for lower rates. Stay right there. There are no sure things in investing, Elizabeth, but it's pretty good odds that we're going to see interest rates coming down, which gives investors an opportunity to move ahead of that. What are your suggestions?
That's right, Jack. The September rate cut is now in the cards. So what does that mean for you? Well, it's not as good news for savers because these plump 5% yields we've been enjoying on our high yield savings accounts and our money market funds are going to start coming down. But it's not too late to lock in rates on CDs. You know, if you're a retiree looking for income, you can still get close to 5% on a 5-year CD. A common strategy is staggering, CD laddering. So you'll buy CDs and maturities 1, 2, 3, 4, 5. When one expires or matures, you roll it into a 5-year one. So that's a good strategy to consider for retirees. And in turn,
I was going to say, should you put as much money as possible into the longest dated ones on the theory that when you try to go in a year or two from now, you're going to get lower rates?
Well, that's a good question. As long as you don't need that money, because you got to remember with CDs, they have, early withdrawal penalties. So if you need that money, if you need it, or is there a chance you'll need it, then no, don't lock it up.
Okay. Now, what else do we like?
Okay, so in terms of bonds, we saw a big bond rally this week. Yields are already come down a bit, so a lot of the move has already happened, although some strategists still like sort of the intermediate part of the yield curve between 2 and 10 years on bonds. And in terms of stocks, dividends tend to outperform, dividend payers outperform non-dividend payers in the beginning of an easing cycle. All
righty, good advice, Al. Let's go to an actionable idea from you. What do you have?
Chipotle Mexican Grill. We surveyed us, and we all like burritos and tacos. It's down about 15% over the past month, and this goes in the category of it's a high-quality company, buy the dip. And if you really need a reason to buy the dip, brisket is coming.
The guacamole dip?
Yeah.
Why not?
It's a chip stock.
Ben? Nice. You have an idea?
I'm looking at, speaking of biotech stocks that we talked about before, I'm looking at Amgen, which has earnings next week. The stock actually held up really well. It was down less than 1% this week. It's supposed to have some good numbers, has a 3% dividend yield. It looks pretty good here.
All about pharma and recession resistant, right?
Exactly.
Alrighty, thanks, guys. To read more, check out this week's edition at barrons.com. And before we go, we've got to acknowledge how relieved and overjoyed we are to have our colleague Evan Gershkovich finally back on U.S. soil. He was released from Russian custody after 491 days as part of a prisoner swap this week. In a display of true fearlessness, he left a request in Russia for an interview with Vladimir Putin. That's all for us. We'll see you next week on Barron's Roundtable.